Well, I told Brandon, I said, I really want to do this one. This is, when you get into the macro data and the market and economy overall, I really like to study that stuff. You know, Brandon does too, but I dig into it probably a little bit more than him. Matter of fact, he thinks I'm a little bit ridiculous in how I look at things and go through that. But that's okay, it's a good mix. But ultimately, the other thing that I'll tell you is we're in the process, and we mentioned this last meeting too. We've got a gentleman that we're going to hire that's a chartered financial analyst, a CFA. That's good for our team because Brandon and I both are certified financial planners. Obviously, we're looking at every aspect of the financial planning process, the estate planning process, and there's certain partners that we need to work with to make things happen in the most efficient way to accomplish your goals. But having a CFA on the team is really going to help us because he can dig into balance sheets like no other. And it's going to be a great thing for us to have. He's going to be a full-blown advisor just like we are, meeting with clients. Again, as we talked about before, our firm's a little bit different. We work as a team. We don't have certain clients that we work with. Brandon can work with clients that I normally see, vice versa. Matter of fact, that's a good thing. And you're able to see two different opinions and approaches, although I think they're pretty similar. It's great for the clients to have the ability to do that. So we're happy that we've got a new team member joining us. When is it, March 10th? Yeah, March 10th, he'll be joining us, and he'll be sitting in on appointments with me and Brandon and getting familiar with everybody. But obviously, if you bring those technical questions, we should be able to answer those now going forward, and feel really confident about that. Currently, he's with Bank of America, but again, we're bringing him over to the independent side with us, so we're happy about that. Also, we've got another team member that's joining us, going to be part of the service team. She'll March 10th too. March 10th on that one too. So we will have 4 team members on the service team. Again, our goal is to continue to grow, and y'all been very gracious with the referrals that y'all sent us, and that's how we've grown 97, 98% of our business year to year. So we appreciate everything that you're doing for us. But ultimately, we want to make sure that we're able to layer in that level of service that you expect. And the only way we can do that is add new people. And of course, we'll make introductions of those individuals and involve them in the events that we do. And as long as you continue to say that you want to do these, then we'll be here. We'll be here. And I think so far we've had good feedback from these classes. And again, we do some social events throughout the year. Please attend those if you can. But like Brandon said, we're going to talk about the state of the market today. We're going to look at 2024. We're going to venture into 2025 and try to decipher what we think is going to happen. Okay? So let's jump into it. First slide you'll see here, obviously disclosures, keeps me and Brandon out of trouble. But we definitely need to put this in front of you so you can read through it. Okay? So the topics for today, let's talk about 2024 as far as the performance review. Then you'll see the top 5 investor questions for 25 when we're talking about this year. You know, will market performance stay strong? How will Trump 2.0 affect the economy? Will inflation and interest rates fall into 2025? That's a biggie. A lot of question marks around that. What about the U.S. consumer, jobs and housing? That's a biggie too, right? That's going to drive what they do with interest rates most likely. And then how will artificial intelligence impact investments? Again, another big subject. It's going to become more and more important as we move forward. So first and foremost, let's talk about 2024. As most of you know, last year was a really strong year. What you'll see on this chart, I know it's kind of small, but you'll see all the asset classes, including international, emerging, so forth. But the biggest thing that I'll point out on this, if you look at that top quadrant right there for 24, that's U.S. equities. All right, it was up about 25% as far as the S&P 500 is concerned. But what's amazing about that 25% number, about 78% of that return came from the top 7 stocks in that index. That means 493 stocks only contributed about 6 percentage points to the return last year. So that tells you how skewed the overall market is to large cap and large cap tech. Okay, so big companies that have tons of money on hand, ton of cash on the sidelines, did extremely well. Small caps, big caps, although they did well, they're still lagging the large caps. Okay? The other reason that I put this up there there. This last column, and again, I know it's small, but you can see, do I need to turn the lights down a little bit so you can see it? Okay, all right. See if this helps a little bit. All right, here we go. Here we go. How about that? Is that better? Okay. So if you look at the top quadrant here over the last 10 years, again, U.S. equities have been the winner, roughly 13.1% on average per year for the last 10 years. Now, the one thing you don't see in there is the 2008-2009 timeframe. We'll touch on that in a minute, you know how bad that was with the financial crisis. But the fact of it is, you can look at anywhere in the world right now. Outside of the U.S., the average return with the Japan equities was 6.6%. So that's where Brandon, within educating clients and meeting with clients, this is why we're trying to bring your expectations into reality. You know, most of the time we'll run our financial plans at 4 to 6%. The reason we do that, outside of the U.S. and the large cap tech companies, that's where the averages are going to be. Valuations worldwide are cheaper than the U.S. right now. Does that mean we're exposed to the international market at this point? Not right now. And we'll talk a little bit about that. We're all 100% U.S. equity right now. But U.S. equities over the last 10 years have been really strong. So last year, great year, and then on average over the last 10 years, strong. So let's look at specific sectors within the overall market itself. The highest return was in the communications sector. So when you look at that, again, you're dealing with high levels of technology exposure there. You get down into the technology sector, obviously that's going to have some. Consumer discretionary is going to have some. But the majority of this is going to be wrapped around the large cap growth index. So when you look at that, that includes technology. So this first 5 industry groups here are going to be highly allocated towards technology, except for, of course, utilities and financials. Honestly, utilities were a surprise to us last year. They pay dividends. The utility companies, think of Duke Energy, local, did really, really well. But prior years, not so much. But last year, utilities and dividend payers did well. Financials did well. Why do you think financials did well? Interest rates went down 1 percentage point last year, right? So that picks up activity when it comes to the banks as far as lending is concerned. We're hoping that interest rates get cut again this year. If that does, maybe it'll spur some additional growth within the financial industry. We hold 10% of our portfolios currently within financials, and there's a reason behind that. But overall, the market itself, all sectors perform very well. Outside of energy, real estate, healthcare, and materials, those were the laggards. When you look at the bond sectors, we're not overly optimistic about bonds right now. And you say, well, why is that the case? Interest rates are high. Interest rates are high, but if we were to buy bonds, we're hoping interest rates continue to be cut in the future. Well, based on the latest unemployment numbers and based on where inflation is, it's ticked up a point or two over the last couple of months. We feel the Federal Reserve is going to be really strained in regards to its ability to cut rates as we move throughout 2025. Now, this is a total game changer from where we thought we were 4 months ago. So this year, based on what we're looking at, there's about a 70% chance of a rate cut in June, and then another one in the September timeframe. So if we're lucky, we'll get another about 0.5 point or 0.5% cut off the federal funds rate before the end of the year. You say, well, why is that important? For every 0.25% that they cut in rates, that really flows or puts back in about $90 billion in cash back into the system. So that's a massive number. Think about last year. Cutting those rates 1 percentage point unleashed about 300 to 360 billion back into the system. You wonder why the market went up? That was a big part of it. Okay? So this year we're hoping for that 0.5 point cut, but based on the numbers we're seeing, the Fed might not do anything this year. The fact that we're not going to have those rate cuts, or we don't expect it to be as robust as what it was last year, still makes us cautious on overall bonds. Now there's one area that we do like, which is the short-term treasuries. Really what that is, that's structured around money markets. You've heard of money markets, right? So the money markets over on the Fidelity side right now, we're able to get somewhere in the neighborhood between 4.25%. When you look over at your banks and you say, well, why aren't they paying me 4.25%? Well, the reason is you build these things out by buying very short-term U.S. treasuries. Well, the banks are basically keeping that spread between what they're earning on those treasuries and then what they're paying you. So if you go to the bank and you're earning 1.5%, you wonder why you're not getting the other 3 percentage points. Well, the banks are keeping that. That's the way that that's operating, and that's the way they do business, and there's nothing wrong with that. They've got to be profitable in some form or fashion. That's how they're doing it. They're building out their net interest margin. Also, you got to think about where we are as far as interest rates right now. If you go get a 30-year mortgage, what does it cost you? 7.25 right now, if we're lucky. Well, that's a lot higher than 3, where we were 2.5, 3 years ago. So lending has slowed down considerably. So they've got to make up the profits somewhere. That's how they're doing it. But on the money market side, with the money market mutual funds, we are able to pull a higher yield than what you can get at the bank. So if you've got extra money sitting in the money market earning virtually nothing, give us a call. We'll find a solution for you. So that's why we like those short-term treasuries. We hope this changes going forward and we can get back into the bond market in a bigger way. But as of right now, we're using alternatives compared to bonds. The other thing I'll point out too, when you're looking at bank loans, you're looking at high yield bonds, really those are kind of hybrids of what you would experience by owning stocks. So they do carry more risk than regular treasuries. So again, if we're going to own something that carries risk, it's going to be in the stock side of the equation. Okay? Here's a 24-month cumulative return of the most robust sectors within the market compared to the ones that have lagged. And what you'll see, again, we mentioned large cap growth, that's where we're at. It's got the highest return over a 2-year period of time, roughly about 60%. That's unheard of. Well, the reason that's occurred, inflation came down big time, interest rates were cut, a lot of money flowed back into the market. So there's your benefit of that money flowing back into those large cap tech companies, and that's what we've experienced. Little unusual though, kind of hedge against inflation again, gold has actually rallied for the first time in years. Over a 2-year period of time, gold's been a good performer. But outside of that, you can see where small and mid cap sectors, international sectors have lagged the U.S. large cap market. Again, that's why we're staying within the U.S. domestic exposure, very little international exposure, if any. We do have some exposure to international economies from the simple fact that companies like Apple and the big tech companies, they sell a lot of their product overseas, right? So you've got indirect exposure, but most of the companies are based here in the U.S. that we own. So moving on, let's talk about 2025. The top 5 investor questions for 2025. Well, we'll start off with, will the market performance stay strong? There's bullish sentiment around stocks, AI, new administration. Well, I can say probably 50% of this room believes we got momentum with the new administration. 50% probably don't, but that's okay. But favorable U.S. conditions overall. When you look at the overall investment banks, the analysts out there, you'll see how bullish they are here in a second. And we'll talk about, is that a good thing or a bad thing? We'll evaluate. Second thing, there are no bargains in the market right now. If you look at the overall valuations of the market, very, very expensive compared to historical numbers. So we've got to be careful with that because that is all the growth priced in right now, potentially. And we'll have to pay attention to that one. But investors would do well to temper the expectations going into 2025. That's the biggest thing that we've got to do. The last 2 years have been so robust. Everybody's got the double-digit number in their mind that we're going to do this in the market every single year. That's not the case. That's not the average. Everything comes back to the mean. So we've had 2 good years. I would expect at some point we're going to have a breather. Does that mean a down market or a flat market? Probably so. All right, so will the market performance stay strong? Let's look at the Wall Street expectations for the S&P 500 returns. Now what I want to point out, this starts with Oppenheimer, Wells Fargo, Deutsche Bank, You got BMO, Bank of America, all the way down through Morgan Stanley. But you got all your investment banks here. You'll see the red line. The average is about a 12.5 to 13% return expectation for the S&P 500 this year. I will take it if it happens. Here's the problem. Normally, when everybody thinks that the overall market is going to be that robust, are they right? No. In other words, you want to go the opposite direction when there's too much positive reinforcement to the market and what expectations are moving forward. But that being said, I am a believer in the U.S. economy compared to other economies around the world. I do think we have the best managed economy in the world, and that's why, again, we're still positive on the market, just maybe not as optimistic as Oppenheimer is with the 20 to 22% return expected. Okay? But you can see all investment banks are very positive on the U.S. market right now. Statistically, the first year of a presidential term is positive. So we'll just have to see how this turns out. But that brings me to reality. All right, when things get too bullish and everybody wants into the game, let's visit a couple periods of time where we needed to kind of put that in check. So go back to October of 2007 through March 2009. There was almost a 60% correction peak to trough in the S&P 500. Now think about that. Let's put it in real numbers. Let's say you had $1 million in assets, to make it easy math. If that million goes down to $400,000, how do you feel? It's a bad day, isn't it? That hurts. We'll look at it in a shorter period of time, same block of time, September 2008 to September 2009, just in a year's time, there was a 43% drop in one year, 12 months. So again, $1 million goes down to $570,000. That's still very painful.
Yeah.
All right. Then you go back to the technology bust, March 2000 through October 2002. Peak to trough correction, negative 49%. Again, $1 million goes down to $510,000. Still very painful. And then probably the biggest, most shocked everybody got was during the COVID month of February 2020 to March 2020. If you look at that time frame, we're talking a little over 1 month. It might have been about 5 weeks. We had a 34% correction in the market. It had never happened before in the history of the market. So $1 million, do the math, goes down to about $660,000 in a month's time. The reason I bring this up is everybody was bullish at the time right before this. In every case. That's kind of where we're at right now. The beauty of it is it's not overly bullish right now. It's kind of middle of the road, a little bit tilted toward the bullish side. So percentage-wise, it's not in these scenarios at this point, which is good. But we also want to, point out that this can happen, and it will happen. We just don't know when. Statistically, 1 out of every 4 years is going to be negative. Okay? We haven't experienced that over the last decade or 15 years. We haven't hit the averages. Eventually, it will come back to the averages. But that's also why in the portfolios we use products that are called buffers. We own the large cap market, but we're putting some protection underneath that. We have 35% of our overall equity positions hedged right now in the portfolio. It doesn't mean we don't want to participate in the market. We're just saying if we're wrong, let's have some protection in place. So we've got that in place right now. We can change that at any time. I just don't see any indication for us to make the change at this point. And then Brandon and I were talking about this the other day. If you look at the hedges that we got on, it's allowed us to outperform the market year to date. But the problem is the hedges have actually been the only reason that we've done that. We participated up in the large cap market. We participated down. But those hedges muted that downside. And that's why we have them in the portfolio. How will the second term of President Trump and the administration he's trying to put in place, how will it work? So here's what's expected. Tax cuts. Well, it's through the House at this point. Let's see if it gets through the Senate. If it gets through the Senate, it's going to go to his desk. He's going to sign off on it. So what does this mean? The current Trump tax cuts that we got in 2018 right now most likely will be extended. And if they get extended, we feel like that's a tailwind for the market. At least we have expectations of lower tax rates for a longer period of time. Again, they were supposed to sunset on 1/1/2026. What we're hoping for is they extend this out to 2034, maybe beyond. But we'll have to wait and see. Again, through the House at this point, let's see what happens in the Senate. Look at deregulation. He's just wanting to open the market to the private market and let companies do what they need to do. He doesn't want to restrict companies from expanding, research and development, acquisitions, you name it. If it makes the U.S. economy stronger, he wants to be able to allow the companies to do that. Immigration. Immigration has come down significantly since he's taken office. Been in office about 5 to 6 weeks. Is that a good thing, bad thing? I don't know, but we'll figure it out. They're going to have the statistics to show us what's going on. Tariffs, big item. You probably hear about it every single night on the news. Well, the tariffs are a big deal because what President Trump is trying to do and the administration is trying to do is set up a reciprocal relationship. So if the UK is going to charge us 10% to buy one of their vehicles, well, guess what? We're going to hit them with 10% when they ship it over here. We're charging 3% as far as the United States is concerned right now. The UK charges us 10% to sell one of our GMCs or Fords over there. Well, what he's wanting to do is even that playing field to a 10%, or just bring it down to where it's free trade at that point. That's what he's doing. He's using these tariffs as negotiations. Now, will it work? I don't know, but in the short term, could cause some instability. Shifting global trade flows. We'll look at a chart here in a minute. You'll see what I'm talking about in regards to that. Deficit uncertainty, lower tax revenues. If he cuts the taxes or keeps the tax rates low, lower tax revenues will go in to help us pay down this debt, right? So when you look at that, we're hoping that tariffs, growth, and then Doji, everybody's heard about that, right? So they're looking to tighten the belt on all these government agencies and the government spending. We'll have to see if it actually works. But in the short term, this could create some inflationary pressures on the overall economy and market, okay? Which creates uncertainty at that point. So when you look at this chart, this chart's got a lot of green, red lines on it. So when you look at this, what it is the expected trade flow changes from 2023 to 2033. We're looking at the U.S., and then we're also looking at China. But what you're seeing here is you're seeing a decrease in trade between the U.S. and China, but look what happens to all other areas. The U.S. accelerates trade with different countries around the world. You can see Mexico's a big contributor to that. Canada's a big contributor of it. Germany, so forth. Japan's another big one. But what China's going to do if trade with the U.S. goes down, you can see they're going to form a bigger relationship with South America, Africa, and then also emerging markets. So China's not going to lose in this deal either on the tariff side of the equation. What we're trying to do is increase trade in both directions, and I think it's going to work for both economies. So there's a positive both ways. But even China, I think China slapped tariffs on us as far as retaliatory of about $21.2 billion in the last 2-3 weeks, I believe. But if you look at that, it's just trying to, again, level the playing field to what they're charging us versus what we're charging them. And it's a negotiating tool. Let's see how it works out. But yes, some of the goods that you're buying could cost more in the short term. So be prepared for that. Now, how do you counteract that? You cut taxes. Put more money back in your pocket, you can buy those eggs that cost 15% more. But that's the way that they're trying to manage this. Again, I don't know if it'll work. It's definitely a different type of an approach than what we had before. Markets expect falling inflation and interest rates. Well, I would have said that's true as of the beginning of the year, but it's drastically changed a little bit from, I say drastically changed from probably fourth quarter of last year to where we are today. You know, we were expecting another full point to a point and a quarter coming into this year. Now it's down to the potential of only a half a point cut. And it's because inflation's ticking back up. Gone from 2.9 back into the threes. You look at some major policy proposals promote growth, most add inflation pressures, definitely. We're talking about the tariff side of the equation, cutting back on government spending, so forth. The largest known market risk for 2025, again, is high inflation and interest rates. Will tariffs cause the market to become inflationary? We'll have to wait and see. Again, nobody knows. We're hoping he negotiates this to where we get kind of a fair trade type situation. But there's one thing for sure, they're being aggressive with it right now. They're not holding back. So when you look at a chart in the short term, yeah, I think tax cuts are on the table. Again, gets through the Senate, he definitely will sign off on it. Deregulation's on the table, gets through the Senate, he'll sign off on it. But in the short term though, tariffs, immigration crackdown, shifting trade flows, deficit uncertainty, those are negatives. Those could be negatively impacted based on the policies that you're trying to put in place right now. Short-term inflation, you see a green check all the way down, right? All right, so that's why we're worried about the inflationary side of the equation. If we get inflation that goes up, can the Federal Reserve cut interest rates? No. Chances are they might increase interest rates to counteract it, just like they did before. So they've got to be careful. It's a nice balancing act. Cutting interest rates is positive for the market. Rising interest rates normally are not. Creates a challenge in the short term. So when you're looking at inflation, we got certain items up here that, of course, impact everybody. But look at the 12-month change in prices by percentage. Some of them have corrected. Some of them, appliances, electronics, rental cars, furniture. Some of those prices have dropped year over year. But then you go back to the left side of the chart. Look at the number one, auto insurance. Anybody notice that? I have. I've noticed that. But then also prescription drugs. Rent's up about 4 to 5% year over year. It continues to go up. If you look at rents compared to owning a home right now, there's about a 40% separation of what a mortgage costs you versus rent. So renting right now has become even in more demand because it's so expensive to own a home right now. Okay? So yes, inflation's hitting all of us. On average, it's around 3%. You'll see the little red bar there, or pink bar. Overall inflation's hovering around that 3 to 3.1 range. Government is trying to get that, or administration is trying to get that to 2%. I don't know if we'll get that low again. This might be the new norm, 3 to 4%. Okay? So what about the U.S. consumer, jobs, and housing? Well, expect to see strong jobs market as we've got right now, but higher interest rates. This morning they reported the unemployment numbers, first tick up in unemployment we've seen since October of 2024. You look at it and you say, well, is a negative a positive? In this case, probably so. If unemployment continues to tick up, then the Fed's going to have to counteract that with lower interest rates. Well, the market likes that. Sounds unfortunate, but that's exactly what's happening. They blame the unemployment number that ticked up in the most recent week in February 22nd ending. They blamed it on weather, which is probably true. If you've been keeping an eye on the weather nationwide, it's been pretty rough. So it makes sense. So it may be short term. That tick up in unemployment may be a false number. We'll see going into next week and weeks to come. Higher mortgage rates, well, you know the story. We were down 2.5%, 3% when you buy a mortgage. Now it's, or get a mortgage, now it's about 7 to 7.5%. That's quite a big difference. Anybody that owns a house and you have a 2.5% to 3.5% mortgage, guess what? You're not going anywhere, are you? It's hard to move from a 3.5% mortgage to a 7.5% mortgage when you know you got a pretty good deal. Probably never see it again. So inventory continues to be a challenge, but also the mortgage rates being higher puts more pressure on individuals being able to afford any starter homes or new homes. Average contribution to the U.S. GDP, or gross domestic product, which is our growth from the real estate market, is 20% per year. So you can see how impactful the overall real estate market is to the growth in this country. If we have higher interest rates, that puts additional strain on our growth. Our growth came in the mid-2s, so 2.5% for GDP. That is below where they want to be. The inflation rate's at 3. We're below the inflation rate. So their hope is to get that inflation rate back into the 2s so they can get those to match up. Growth, they like to see it around 3% right now, but again, it's roughly about the mid-2s. I don't know if it'll get much more robust than that. But again, housing is a huge part of it, about 20%. So what about the U.S. consumer jobs and housing again? On housing and jobs, you look at it, the overall unemployment rate right now is floating somewhere in the neighborhood of about just slightly below 4, maybe 3.9, 4, somewhere in that range. But if you look at the mortgage rates, again, being at 7, 7.25, what's weird about this chart is, you know, everybody looks at it and thinks, man, mortgage rates are really, really expensive right now. They're not. They're basically the long-term average. If you go back to the early 80s or late 70s, do you remember that? Yeah, they were double digits. So right now, when you're talking about 6.5% to say 8% mortgages, long term, that is the average. We are living in a normal environment right now. It's just most individuals don't even recognize it, especially the individuals that just came out of college now that might be 30, 35 years old. They haven't seen anything but 0% interest rates. That's what they experienced growing up in their first decade of employment, 0% interest rates. It's not there now. So we're back to reality. It's going to be a little tough. We'll have to see what happens from that end. And until these interest rates come down a little bit, I think the housing market continues to struggle. We've got to get inventory up. We've got to be able to give people the opportunity to own a home rather than rent at the current rates that we're at right now. But that separation doesn't line up right now to where it's favorable. If someone comes in to me in Brandon right now, we honestly think renting is a pretty good deal right now compared to owning a home. The separation of about 40% between those two costs is ridiculous. Normally they kind of trend in parity. There's not a lot of separation. So if you're spending $1,500 for rent, you ought to be able to go buy a home for $1,500 a month. That's not the case right now. $1,500 in rent, you go buy a home, you're going to spend $2,500. That's the difference. Normally they're together. So something's got to happen. Either rents are going to go up or mortgage costs are going to come down. Let's talk a little bit about AI. AI is not a magic wand for portfolio management. It's difficult for algorithms to model fear and greed, and that's the big one. Those are the two emotions you're going to deal with when you're talking about investing. Yes, artificial intelligence is a good thing. I use it every day. Saves me a tremendous amount of time looking up certain data, research, macro data in regards to the market. I can do it in minutes now where it used to take me hours. It's great. But AI can complement professional management by providing enhanced analysis of large data sets, which again, I do every day. I use it. It's wonderful, wonderful. Identification of complex relationships in the market, yeah, it can find that too. It can identify when trends, when money flows are going in and out. It does it in seconds, whereas it would take hours to analyze that. Real-time spotting of trends and trend reversals. We can see that immediately now, whereas you had to do a tremendous amount of research to break that down. Algorithmic trading based on predefined parameters. That's where AI is really good at this. AI comes in, sets up certain parameters, trades around those parameters, takes all the emotion out of the game. The thing is, if market crashes occur, they're always going to keep you in the market at some extent. So you're going to experience the pain regardless of what you use if the market gets bad, but you also participate in good markets too. So AI has been a huge, huge component of that. Sentiment analysis and extrapolating bullish from various signals and language. It's great. AI does that for us too. We have a program Brandon and I use right now that's utilizes artificial intelligence, also the algorithms, and it tells us from a money flow and volatility standpoint whether the particular company at the time is positive for a purchase or stay on the sidelines, wait a little bit before we enter an individual equity. It's not always right, but it does help us because it takes the emotion out of the game. And that's what it is. You've got to make a determination based on the fundamentals whether you want to enter a certain particular stock or not. In our case, most of the time we use it for exchange traded funds. I use it for the S&P 500. I use it for the NASDAQ because I want to know what the general market is right now. The general market right now, shaky ground. You know, we're on the fence. So we got to see what happens in the next month and how we're going to work all this out to determine how the rest of the summer, well, spring and summer are going to go as far as the market's concerned. That's why we have 35% buffers right now. We want some level of protection in the portfolio. All right, improved management of hidden correlated risk. This is something that it does very well too. I mentioned kind of how we use that as far as structuring the portfolios. But those that leverage AI, potentially can present some gain to you long term. I don't know if you've used it in the past, but again, we're using it on a daily basis. Once we get the CFA in-house, we're going to use it even more at that point. Okay? It's a great thing. You just got to understand how to use it and how to leverage it to what you're trying to accomplish. And we're trying to do the same thing within portfolio management. So the takeaways. Investors have enjoyed unusually strong returns coming into 2025. That's why I raised the flag of using caution. Not saying I'm not bullish, but raise the concerns of caution. That's why we have those buffers in the portfolios, and we've got some level of protection built in. But so far, so good this year. I think it's been a great year. Strong bullish sentiment driven by AI. Everybody knows about those stocks. They went crazy last year. They're continuing to perform pretty decent this year. Favorable U.S. conditions. Trump 2.0 introduces many sources of optimism, as well as uncertainty because of the tariffs. Some major incentives should promote growth, tax cuts, deregulation, some of those that we've mentioned already. Most major initiatives will introduce inflation pressures. Again, we talked about tariffs. We talked about immigration. You're lowering the potential job numbers or people that can be employed by those jobs when immigration goes down. Trade, deficit risk, we've talked about that. The largest known market risk for 2025, again, is going to be high inflation and interest rates. And the Fed, basically. We've always said this, regardless of what the administration does, regardless of what the House, the Senate, the executive branch does, pay attention to the Fed. The Fed will tell you what's going to happen in the market. They drive the market. I will stand here 10 years from now and tell you that the Fed drives the market. And their decisions do. So a 25% cut, again, as I mentioned before, means an additional $90 billion in impact on the economy. Cutting interest rates by 1% in 24 created $360 billion in relief. We talked about that. That's why we think the market rallied in a big way. Consumers should expect to see continued strong job markets, but still high mortgage rates. I just don't see that changing. I just don't see that changing right now. Interest rates, I just don't think are going to be cut that full 1 to 1 1/4, probably around 0.5%. The investments, like other areas, artificial intelligence can complement professional management, what we do. And like I said, we're utilizing it every day to help us make decisions. Those that leverage AI can potentially achieve an edge. To a certain extent, I would say yes, analyzing the macro data and trying to understand the economy as a whole. But ultimately, you've got to make your own decision because the two emotions, fear and greed, I don't care how good AI is, it's not going to get that out of your mind and what you see on paper and the fluctuations month to month that you experience. Potentially be a really good year, but we've got to understand where interest rates are going. We've got to see how tariffs are going to roll out and what that means to the U.S. economy. But in the short term, let's get that tax bill through the Senate. President Trump signs off on it. We've got clarity. That's a tailwind for the market. The tax rates are going to remain low. Had a couple people ask me about Social Security and the current tax bill that they put on the table for approval. There's been no adjustments there. Remember we talked about potentially Social Security not being taxable going forward? It's not there yet. They're doing this first part at this time. We've got to see how the other programs go before you get to that point. So don't get too enthusiastic about that, but it may be on the table. Okay? That's a big deal if it happens. Think about it. That's huge. That's huge. But we'll have to revisit that when it actually happens from that standpoint. But I'm going to open it up for questions. That's pretty much 2024-25. I know it's really detailed, but feel free to ask whatever you want to. Any questions?
I'll touch on something. One of these, the former charts, let me get back to here and show it to you. Maybe
That's the things.
No, this one right here. So when we're looking at this, obviously these numbers look really strong, and they are. But you got to think about what happened 2 years ago, right? That was 2022. The market, that was the worst down slide we had in the market, a sustained downturn we had in the market since 2008, right? So we've been really, I say, spoiled with market returns. As Trent was mentioning, we've been spoiled with interest rates, right? So I think the market's done fantastic, and that has been on that large cap area, and that's where we've been focused. That's why you don't really see us looking at a lot of mid and small cap and things like that. But you know, it has such. What I want to point out was the market was down in 22. It was a bad year, but over 20% on the negative side.
Yeah, technology index was down 35.
Yeah,
So it was bad.
So when you're looking at that, what the point I'm trying to say is we're looking at the data saying, hey, things might not look so great right now, but we're ready. It could keep going. You know, fear is a very powerful emotion. Analysts, news reporters that fear, they get more reaction out of fear than they do positivity, right? And so keep all that in perspective. But after every major downturn, there's been an even stronger correction on the upside. So that's what I was saying. If the market was down like that, you're coming off a low year, and you see how the rebound happens. So when it does happen, and it will, again, we don't know when, don't know how long, that's why we're always prepared. We're going to lean on the fidelity accounts when the market's good, and they'll do fantastic. We've got, as Trent mentioned, some protection or buffers in there when things do go south. Like I said, we're beating the market now because there has been some negative headlines and volatility this year. So those buffers are doing their job and protect, right? And then on the flip side of it, there's another chart in here talking about the fixed income piece. Again, that's why we'll look at alternatives when you're looking at fixed income versus, you know, if we look at maybe an annuity space, because it can provide protection. Yes, there's some strings attached there, but we think the trade-off's really well. But what we can know is how much risk we want to take, what the historical looks like. Don't let politics cloud your judgment as far as how you want to invest your accounts. That's a big deal.
We can't say enough of that. When it comes to the political side of the equation, it's so polarizing right now. Don't let it drive you to make a decision that you normally wouldn't make, okay? Because I'm telling you, when it comes to the market, I don't care what's happened politically, look towards the Federal Reserve and what they're saying. Because if they unleash the liquidity in the market, correlation, when there's more liquidity, the markets do well.
And as you mentioned too, again, when we do our planning, we run it at that kind of 4, 5, and 6% rates of return over time, because that's where the averages are. Yeah, the last 10 years I've been better than that. You can always tell people.
Only in the U.S.
Yeah.
Everything else, 4 to maybe 6%.
Right. So again, I'll tell people the market last year was fantastic, right? We had double, triple, quadruple that, depending on how much risk you're taking, but it gave us those returns, and market will take some of it back. I do the same thing. I have this high water mark. Man, my account's up to here. Yeah, it'll never drop below that. No, it will. You know, you gotta keep that in consideration. But it's okay. It's the long-term approach. It's the big picture. Anytime if crazy volatility does happen, let's talk about it. Let's sit down. Let's look at the plan. Let's look at the big picture. I guarantee you'll leave feeling a lot better than you came in if again, something really nasty happens. But we got your back. We've got a plan in place, and we're ready. So again, feel free to reach out if anything that happens. But now, any other questions?
This is sort of a loaded question, but if our government continues to spend as they are with a major deficit every year, how many years down the road before the bubble bursts?
I wish we knew that answer. Seriously, I wish we knew that answer because, you know, when you look at, I'm not going to call it entitlement programs, but, you know, Social Security, Medicare, it's not infinite to where the revenues that we're bringing in on an annual basis from a tax standpoint that match up to the cost that's associated just with those two programs. Forget about defense. Forget about other agencies that are being funded. We don't have any money left. So Medicare and Social Security are going to be the top two programs that will get the majority of that revenue as far as funding. And if we don't have any more money to fund that, then what happens to everything else under it? And for me, one of the biggest ones is defense. If we don't have a defense budget, that's a problem. That's a problem. So I wish I knew the answer to the revenue problem, but or the so-called bubble bursting. But I think that's what this administration is trying to identify. Is there waste out there that can be wiped out? We no longer have to revisit it. Can we put more efficient programs in place? And how do we operate that? That's why I'm saying, I don't know if 4 years is enough time to be able to pull this off, but they're working as hard as they can to try to identify what they can. And also give those individuals that may be impacted some time to potentially transition into doing something different. And that's a difficult thing to do. The balancing act that this administration is trying to pull off is going to be monumental. And we'll have to see if it works, but yeah, I wish we knew the year, because we would get out if we knew. But unfortunately, we don't.
Well, we know it can't last forever if they don't get it under control.
That's right. Once you get to about 50 trillion in debt, we don't have enough revenues to fund anything else outside of Social Security and Medicare. That's it. I don't want to call it game over, but that's really the tipping point. And that's not too far down the road if things don't change. Yes, sir.
Do you know or do you hear anything about what the, like Social Security may be phasing, I don't mean phasing it out, but approaching it a different way to where the money is not extracted from the employee, it's given back to the employee to invest on their own?
That's I'm gonna say not specifically, but in the past, when you revisit that to have private investment with your Social Security funds, that's been on the table multiple times and it's just never gone anywhere. If they would have done that, we probably wouldn't have an issue right now.
Well, that's what I was thinking, is if you could give it back to the person, now it would take responsibility and dedication.
Oh, absolutely.
That's the problem right there.
That- yeah.
I think everybody in this room probably can handle that, but I don't, the vast majority of people couldn't handle it. And that's kind of why they're, in my opinion, forcing it, right? You're seeing them do this in the 401k space with the Secure Act and Secure Act 2.0 they've passed. They're trying to make it mandatory that people, that when they join a job, they automatically enroll into the 401k and it's automatically taking money out of their account to save. Because if they don't, if the government doesn't force them to do it, they're not going to do it, and then they're going to be even a bigger burden on society and the government programs down the road, right? They can opt out and not they can stop it, but it's just trying to get people started, right? I mean, so I think, yeah, if you put that on the individual, I mean, we see it all the time. We do 401k plans and simple plans for small businesses, and the employees will come to us and say, I need to take money out to buy this boat or whatever. You're going to get eaten alive in penalties and taxes. Yeah, well, that's all right. I'll do it anyways, right? I mean, there's a lot of people that will go in their retirement and get it because they want it now, right? So
That's true, but if they were to build restrictions into a program to where
yeah,
you can't touch this, just like a 401k.
right.
You can borrow, but like 59 years old, you have to start taking it out. I believe. I could be wrong, but there is a age that it changes what you can and can't do.
Yeah, usually 59 and a half is when that 10% penalty lifts, but you still got to pay your taxes.
That's
Sometimes
right.
you can do it 55.
What I
But
say,
yeah.
if you could give it to the individual,
Yeah.
employee, if there was restrictions to say, you can't touch this, you can't legalize, you can't cash it in, nothing, until, so it's there, so, to safeguard.
Well, I mean, if you were to look at that, if you go, and looking back is easy, right?
Sure.
Looking forward is, nobody knows. But looking back is easy. If that program would have been put in place 40 years ago, your Social Security is probably double what they are right now.
But you also, too, you have a lot of other government agencies going into that bucket, pulling money for
Absolutely.
other things, and that's a big
Absolutely.
stealing money out of that bucket, right? And Social Security's changed drastically since FDR put it in place, right, back in the day, and it will continue to change, right?
Well, yeah, we don't have the people, when it started, there was 35 employees contributing to one retirement.
Life expectancy is a big deal.
Now it's about 3 to 1.
Right,
Yeah, 2.5, 3 to 1 right now.
but
Yeah, because I think,
And Tony, that kind of rolls back to what you were talking about. There's no more wiggle room for the Social Security and Medicare side of things. And really, that's what I think the administration right now is trying to figure out. You know, what can we cut, permanently cut? And then what can we put in place to make it more efficient? Save money.
basically the reason I ask is because, you know, this system is not working.
No, and I can see Social Security realistically, I can see full retirement age going from 67 to 70.
Yeah,
And if you do that, you're saving hundreds of billions of dollars. Well, or billions of dollars. Let me lower that a little bit. But then if you go and increase the minimum age you can draw Social Security from 62 to 65, there you go. There's another few $1 million that come into play. So there's different things that they can do. The beautiful part about that, historically, they've always grandfathered those that are in the Social Security system and actively participating now. You're in. It's those that aren't eligible for Social Security right now that take the brunt of it. So yes, the younger generations right now, I think need to prepare for something that's going to be drastically lower than what they're expecting.
Just to kind of add on to that, I mean, projections are that in less than 10 years, I think they're saying 2034, for the first time in history, we're going to have a demographic flip in this country. We're going to have more people population-wise 65 and older than we have 18 and under, which opens up a whole bigger can of worms in terms of funding and these programs and so forth. Are you hearing anything in the research that you all do about that?
Well, there is a demographic shift, and the problem with what you just mentioned is the one thing that, you know, we talked about Medicare, we talked about Social Security, but, you know, those two programs don't cover the major expense that's coming, which is going to be the long-term care side of the equation. So that's another angle that you've got to figure out. There's alternative programs you can use. I can't mention some of those programs because compliance won't allow us to talk about them. But I tell you what, those programs are very beneficial for folks that would, you know, want to put those in place, and we can plan and do some of that planning with you one-on-one. And it happens that Rudy's one of our individuals that we refer the business to because he does a great job in coming up with solutions when it comes to healthcare and coming through with alternatives to healthcare that we can increase your cash flow throughout retirement to help balance that off. So there's additional things we look at within your financial plan, and that's why it's so key to look at this as a high level to where you are right now. You've got to plan for every aspect throughout retirement because your retirement funds are only so much. But we got to make sure that we're covering the income cash flow, but also taking care of the health care. But, you know, again, specifically, I can't probably answer that question, but I think there's alternatives we got to look at in order to plan for that.
I think it puts more pressure on something being done, changes to Social Security.
It has to, and that's why I think the delay of actual start of Social Security and then, of course, full retirement age is going to change in the future. It's got to. Otherwise, the only other way to do it is tax revenues. And that's not something that this administration wants to do. You got to remember, back in the day, it's a fact. Tariffs and the revenue generated off of tariffs were enough to take care of all the taxes that we need. But that's not the case now. But again, the new programs may lead us in the right direction. All right, any other questions?
How much do you think AI is going to affect unemployment?
I think it's going to impact the employment in different ways. I mean, there's going to be a whole new subsector that it creates, but then there's going to be also a demographic that gets hurt by it because it's gonna make things more efficient, and those individuals aren't gonna be needed anymore. And I think that's what scares me. The only way to get up to speed and be able to get on the other side of that where you can benefit from AI is you have to be trained and educated. So there's gotta be a level of education that's driven toward improving employees' knowledge of AI so they can actually participate in that growth. But I definitely think it's gonna impact it. I'm gonna be honest with you. When you look at artificial intelligence, I think if you're in the service industry, I don't care what it is, banking, whatever it is, I think you're gonna be impacted. And if you go in with your eyes shut, it might be a bad day for you in about 5 years because you won't be needed anymore.
And I think you can see how technology's changed banking as it is today, right? I mean, you know, me personally, I don't go to a bank branch that much. I know some of y'all in here do just because that's what you're used to doing and you feel become more comfortable about it. But I mean, I couldn't tell you the last time I was in a bank branch, right? And you just seen offices you kind of shut down in the banks, and I mean, and then it's teller only or go into the front desk or online only. What is it, like there's a credit union actually called self-serve credit union or something like that? And I was like, wow, they're just saying it like it is, you know? So I think technology has changed a lot of that already. I mean, AI will definitely, I think, help processes. Again, that's how we're using it in our business, is just helping us gather data, analyze data a lot quicker and more efficiently. So hopefully you'll see some other opportunities, other benefits happen with AI on that front.
I'm telling you, with artificial intelligence, if I were going through college right now, it'd be a game changer. I mean, it'd be so easy. I'm just saying it because I know what I went through. You went through it. I know what I went through going through college and how difficult it was and all the research we had to do. And I can't imagine having that in my hand and being able to get it in minutes when I had to spend hours and days.
Yeah,
A lot of sweat and tears there. I mean, it was tough.
I've always been curious of what happens to libraries on campus nowadays. Because they don't even do like books for school.
No.
Pretty well.
But artificial intelligence is going to change what we're doing going forward every single year, and you're going to see it progress and get even better as we move forward.
That means it's gonna be more money gonna have to be funded for education and stuff too, then, correct?
Absolutely. And I think it's going to have to be targeted to certain technologies. I don't think it has to be, there'll be certain areas where, you know, again, we have them now. People enjoy having an education in a certain subset that may not be tied to that. Well, how's it going to impact this person? Well, that may not be needed because it can be done over here, and that's what I'm worried about.
Even scarier is the bad guys can take advantage of AI and what it can do. So I think, you know, that what I would say to the people in this room, I mean, I'm an analog guy in the digital world, and I'm feeling pretty good about that right now because I feel safer than a lot of people that are using a lot of the high-tech stuff. Because you're at risk, and
Right.
probably more at risk now than ever.
Right. So when you look at artificial intelligence, the beauty about the U.S. economy is they want to be number one, right? They don't want to be left behind. They don't want China leading the game in AI. They don't want any other country leading the game in AI. So now you've got, you know, $500 billion coming in from one large tech company as far as investment in AI. The amount of money that's pouring into AI, people can say technology companies are dead. They're not going to grow anymore going forward. That's wrong. There's so much money going to pour into technology. I think the U.S. economy is sitting on pretty good ground right now. But there's going to be bumps along the way. But AI is going to be a large portion of that. Over the next 10 years, I think we could have another boom that's similar to the internet. But we'll have to wait and see how that turns out. You got to be careful with it too.
Well, kind of a little over time. I want to respect everybody's time schedule. I know some people got places to go, but we've got your resumes. We've got your surveys on the desk. That's what I'm trying to say. Oh, you come down here later. But no, feel free. I'll hang around as always, ask us questions, and but thank you for coming today.